Hello, and welcome to the Money and Banking Law Podcast with Joe Sylvia, brought to you by Duane Morris, an international law firm with roughly 30 offices and 1,000 lawyers all over the world. I'm your host, Joe Sylvia. I'm a former Federal Reserve lawyer who represents banks, fintechs, and financial services clients on M&A, payments, and regulatory matters at Duane Morris. I'm also a core member of our banking, fintech, and digital assets and blockchain practices. Now, while we can't provide legal, financial, investment, or tax advice on the podcast, our goal for the Money and Banking Law podcast is to inform and educate our clients and friends on both the fundamental concepts and structure of the banking ecosystem, as well as critical developments in the law and regulation of money and banking. Thanks for joining us today. As always, if you have any questions from any of our podcast episodes, please reach out to me at jsylvia@duanemorris.com. On this episode, we're talking about capital raising for financial institutions with Matt Shields, who joins us from Performance Trust. Welcome, Matt. It's great to have you. I really appreciate you being here. It's good to have another great friend on. Can you start by giving the audience a little bit of your background, where you came from, what you're focused on, and what you're doing with Performance Trust?
Absolutely. Thank you, Joe, for having me on. Excited to share kind of what we're seeing in the market today. Backing up a bit for me, I started my career working with community banks in 2004. Had the pleasure of working at FIG Partners for 10 years. Then had a stint of about 5 years at Hovde Group, and now I've been at Performance Trust for almost 9 years. Most of my time today is spent raising capital in the forms of debt, equity, or preferred for financial institutions. Primarily, that means community banks, but we have worked with other companies outside the world of community banking as well.
That's great. Really appreciate it. So, where do you think things sit early in 2026? And what do you have generally as an expectation for this year, and whether it's different from the past, but what are you looking at for this year as expectations?
Yeah, 2026, I think the expectations are high in a positive way. 2025, we really saw a rebirth of, first and foremost, subordinated debt, which was extremely robust. Myself and you have worked on a handful of deals over the years. We were extremely busy in 2020, 21, 22. Those markets kind of quieted down after the initial rate shock we all experienced and really came back to life in 2025. And so as we start out 2026, I think a lot of that momentum that we saw in 2025 is carried into 2026. And I'll add, outside of just the sub-debt world, it's really expanded to common equity as well. Bank valuations in general have moved up pretty nicely the back half of 25 and into 26. So for many years, we were limited mostly to subordinated debt because equity valuations were so depressed. And now with most or many bank stocks trading at healthier levels, it affords us the conversation to bring common equity to the table as well. So when we're working with our banks, it's really talking a lot about sub-debt and probably a little bit more than we have in the past about common equity, when that makes sense for the conversation as well.
Yeah, absolutely. Are those conversations about the equity side of things? Are those coming from the banks themselves, or are they more Performance Trust saying this is also an option that maybe you haven't thought of in the past 5 or 6 or 7 years because of the valuation metrics, because of other things? Is it more from the banks that are starting to think about the equity side as opposed to debt, or is it just another option for them?
Yeah, I'd say the fastball for us at PT are banks 5 billion and below. So we've spent years and years educating banks, not only on sub-debt, but now kind of limping into common equity as part of that conversation as well. And for many of the institutions, they've taken advantage of the years of subordinated debt, and maybe they continue to have opportunities on the M&A side, on growth side, organically, or lift outs of teams, or for whatever reason they might need more capital. And for some banks that are tapped out on sub-debt and maybe can't issue more, common equity can maybe be the right capital alternative for them. So there's education on that front. We continue to see liquidity needs for shareholders. It is always a topic of conversation, and oftentimes that can be rectified through common equity. That might be just an uplisting to OTC. It could be a full IPO, or it could be some sort of private placement that provides liquidity to shareholders. So there's a lot of education occurring. I think a lot of banks need to get smart and getting smarter around the Russell and when it makes sense to uplist from the OTC and into the NASDAQ, and does new common equity come alongside of that? Those are all healthy conversations we're having for banks today that maybe sub-debt is or isn't the right answer for them.
That's a great point. So stepping back a little bit, you mentioned kind of the education of banks and boards of directors and so forth. Where do some of your conversations start when someone is affirmatively looking to raise money? What are those initial steps that you and or the banks should really be thinking about in getting ready for a capital raise?
Yeah, so I think PT is a little bit unique in our process. We tell banks and investors that we are as much an education company as we are an investment bank. Yes, we provide investment banking services, balance sheet strategies, asset liabilities, enterprise risk, you name it. A lot of the things that banks need to be successful participants in their community. But I think what we do is we start out by understanding who the institution is and making sure we understand the strategies that they want to take and make sure they understand who they are. In most of those conversations, I think oftentimes if it's balance sheet specific, it might have historically started with the treasurer. But today, as kind of our expertise has matured, most of those conversations really start and end with the CEO and the CFO. And then when it comes time to really hit yes or no, the board is brought in. But most of the education is brought up through the CFO and the CEO, making sure they understand what types of capital are afforded to them. Because just because you're a bank that's $1 billion or $2 billion, common equity may or may not be the right answer, or it might not even be available to you if you're a private institution, depending on the shareholder makeup and what management is willing to commit to potentially new investors. So again, we like to start out by understanding who they are, what they want to be, understand who that bank is and how it acts in multiple rate scenarios. That's one thing we preach a lot, is understanding what your bank does and how it reacts, whether interest rates go up or down. That's important clarity that any investor is going to want. But once we have that framework and that discussion had, it leads to capital and then understanding what type of capital best suits the needs of the company and the strategies that they have.
Yeah, that's great. You mentioned taking steps to come off the OTC market and look at the Russell and otherwise. Are there specific metrics that you typically will look at for that with respect to an institution, whether it's outstanding shares, capital, liquidity issues, or is it something different that maybe banks need to be thinking about?
Yeah, I think the OTC is a great interim step for banks that want to kind of limp into being a public company. It absolutely provides them a public ticker. It provides their shareholders access through online brokerage systems. It gives them a more formalized professional way to exchange shares. That being said, there's a segment of investors that can and cannot participate on OTC. And so when you think about maximizing the liquidity of your company, of your stock, NASDAQ and NYSE have really become the de facto exchanges for community banks. Now, for most community banks, I'd say the conversation seems to come up most frequently for banks when they start getting around that level of can you be added to the Russell Index? And that Russell Index is oftentimes a catalyst for liquidity. And so, of late, that market cap has been, when you're around 150-ish million in market cap, having a conversation about going from the OTC to NASDAQ or from the OTC going to NYSE, or going from being a private company to a full-blown public company can make a lot of sense. That market cap seems to be an appropriate size to attract, good institutional following, if that's part of your strategy, good institutional interest for new investors, and provide enough liquidity to make it worth your while, the costs associated with being a public company and providing enough liquidity in the marketplace for investors to buy and sell over time.
Yeah. Is there anything that you would specifically advise a bank that's either on the OTC or not currently publicly traded in terms of preparation for becoming a more full-blown publicly traded company? Is it, I'm imagining it's some combination of good governance, good documentation, get your house in order kind of things, disclosures and so forth. But is there anything from maybe more the financial side that you look to in educating these clients to understand what it means to become public and what it will look like going forward? What do they need to do to prepare for that?
Yeah, I mean, they need to first and foremost make sure they have a good regulatory partner like yourself, someone that's been there, done that. As you think about filing Ks and Qs, it's a heavy lift.
Yeah.
And, a CFO that wears many hats in a community bank, anywhere from being the CFO to the janitor to HR, it gets a lot harder as a public company with quarterly filings. As you mentioned, you need to make sure your board is knowledgeable about what it means to them to be a public company and what type of information they can share in and around the community that maybe they could share in the past as a private company versus as a public company. So there's no shortage of disclosure and education. From an accounting standpoint, it's typically 6 months to a year to make sure your balance sheet and audited financials are clean and in a manner that can be digested kind of in a public venue. And then you kind of have to rinse and repeat every quarter that comes about with earnings. You have to get educated and practice around telling your story to the institutional marketplace. As a public company, what you say and do will be seen most likely by the public. So non-deal roadshows, getting on the road, telling your story, attending conferences, and being able to tell your story in a professional and clean manner to investors that might want to invest in your company are all kind of practices and procedures that a company would have to take on if they really want to become a fully blown public company.
That's great. So let's kind of move back into the market trends, what you're seeing. Are there any trends that you're seeing for 2026 that either are new or somewhat unique with respect to capital raising, or what some of the clients might be thinking about or asking you as their financial advisor?
Yeah, the greatest trends we've been experiencing for really the better part of a year or so is subordinated debt. As I mentioned, if we look back to 2020, 21, 22, billions and billions of dollars were issued by community banks in the form of subordinated debt. Most of that are 10-year notes with a 5-year non-call provision, which means after that 5-year anniversary, most of those institutions are going to think about, hey, should I refinance this sub-debt? Should I pay it off? Should I let it float? And so those decisions are being had all over the place with banks of all shapes and all sizes. For Performance Trust alone, if I look at the amount of banks that we've issued capital for and how many of those banks issued 5 years ago, and so are really having those conversations today, for us, it's about $1 billion to $2 billion worth of sub-debt we issued around 2021 alone. And so those banks, now the 5-year anniversary is coming up, whether it be this month, next month, or later this year, are starting to run the math and think about what should we do with that. Should we let it float? For many banks, they are fortunate to issue at kind of really tight spreads. And so the back end floating rate might be lower than where we can issue for them today. I'd say today, as it relates to rates, we're issuing anywhere from the low 6s to kind of the mid 7s, depending on the bank. And that's all pre-tax. So very attractive levels today for banks to issue capital that'll most likely feel like tier 1 of the bank and be durable for 5 years with no covenants and no collateral. So there's just a lot of subordinated debt that can and probably will be refinanced. In addition to that, there's a lot of liquidity coming back on the balance sheets of both banks and institutional investors. And bank sub-debt has been a place that's been a really great place to be, with the exception of a couple of hiccups we've seen over the past couple of years.
Sure, absolutely. And I know from our time working together on some of these deals, there's very generalized types of disclosures as to what the money is going to be used for, right? What are the notes going to be used for? How's the debt going to be spent? Has that changed, or is that changing in your mind? Are people focusing more on using the debt for acquisitions? Is it going to be this refinance type of scenario more than anything, you think? I mean, what are you seeing out there for the market participants in using capital?
The refinance is a big part of the story, and most of the companies that are refinancing today are bigger, stronger, faster than they were 5 years ago. So they might have 20 million outstanding and they might want to refinance and do a little bit more, just to give them a little bit more dry powder. They have more equity capital, they have a larger balance sheet, they have more opportunities. So the refinance is certainly one. As M&A continues to be active and continues to heat up, we think in 2026, subordinated debt for a lot of banks is a great way to fund that acquisition or to buffer capital ratios. And then just general corporate purposes, as you mentioned, organic growth. Things have been strong and continue to be strong, and sub-debt is a very inexpensive way to fund that growth. So those are really the 3 areas that we're seeing most conversations around sub debt today.
Right. It's fascinating. I remember some of the rates that we would lock in for clients back in 21 and 2020, and they were kind of like having a mortgage rate at 2.5 or 3%. It's like you don't want to get rid of it, but at some point things change.
Yeah, but it's interesting. That's a great point, and we talk about that a lot with our clients that say, "Man, I wish I had issued at 3.5," or I think the lowest we ever did was maybe 3%, 5 or so years ago. But as you look at spreads today, and you think about a bank that issued sub debt, at the tightness of spreads 5 years ago at 3%, there really weren't a lot of options to redeploy that capital. Loan growth was quiet. The securities market was extremely low. So your ability to lever that capital was really tough. Today, although you're issuing at 6.5, 6-ish%, whatever it might be, there's a lot of options out there to either lend at rates higher than that or invest into securities of all different shapes and sizes that make that capital really easy to be leveraged. And so it feels a little bit less opportunistic issuing at 6% than it did at 3%, but the reality is your ability to lever that capital into profitable ways today is probably easier than it would have been when you issued at 3%. Now, granted, if you were smart enough to issue a bunch at 3%, wait around and do nothing until rates shut up, you absolutely won. But that wasn't the reality of what most people did.
Right. Yeah, that's absolutely right. So when you're walking clients through not only the structure, but the use of the capital and what the financials look like post-transaction, how far out are you typically looking in terms of those pro formas and, like you mentioned, leveraging what you're acquiring in the capital raise and or the debt that you're issuing? How far out are the bankers thinking about servicing that debt and what they're doing with it?
Yeah, I'd say our process is probably a little bit more robust than most. I mean, we typically like to look at a bank and their balance sheet over a 1 year and a 3-year time horizon. And then we want to stress test that bank over, again, multiple scenarios. So we want to know what you look like today. And we want to know what happens if rates go up 200, go down 200, and everywhere in between. So we really have a good sense of how your bank is going to act in multiple scenarios, as well as stress testing it for credit issues. We haven't seen any real credit issues for quite some time, but that is part of banking, and we do expect it to kind of normalize this year and look into the future. So once we understand all that, we typically like to make sure we understand where the bank is going to be a year from now, 3 years from now, and then sometimes even longer. And that process will really help us illuminate what type of capital is the right solution for them. It might be sub-debt or it might be common equity, again, depending on what they're thinking about doing with that capital.
And are there common touch points every quarter, 6 months, every other year that banks might reach out to you, or you might be reaching back out to clients to touch base on how the capital raise went overall, how the money's being deployed and used? Are there regular touch points that you try and make sure that you hit with clients?
Yeah, I think there's two different levels of touch points. If it's the world of equity capital, it's probably more robust. And so both performance trust, if we help issue for someone common equity, and the institutional investors or the investors are probably going to have more active dialogue. That could be quarterly or at least semi-annually, discussing kind of what's going on the balance sheet, what do earnings look like, and the like. Sub-debt, typically, if you're a good, strong, healthy community bank and you issue subordinated debt and you're making your payments and your balance sheet doesn't change dramatically, you're probably not going to hear from your note holders. We certainly keep our eyes on our issuers quarterly and look at their financials and make sure we understand what's going on. But if things are going as expected, there's really not many conversations to be had between debt issuers and us, a performance trust, and the note holders.
Yeah, that makes sense. That's it's interesting that it's. I mean, I was expecting that you were going to have a positive outlook, right? We've heard a lot of folks talking about positive outlook for M&A, for banking generally, with interest rates and so forth. So it's not surprising that you've got the positive outlook with respect to capital raising. And I think that's probably even more so the case as we hear about more M&A on the horizon and folks wanting to raise capital for that specific purpose. But I wonder, some of the conversations that I've had over the past few years with especially smaller community banks is that they are, potentially looking at options for shareholder liquidity. And you mentioned this earlier on, but options for shareholder liquidity because of a couple of reasons, whether the shareholder base is getting older, they're trying to plan for their estates going forward, or if, the shareholders are in fact the C-suite or certain directors who are looking for a liquidity event because they've been involved with it for 20 or 30 years. Has that been a robust amount of conversation in terms of using it for basically a succession planning tool in some ways?
Yeah, absolutely. It seems like more and more, banks that we're engaging with that maybe want to consider a sale or consider a significant equity offering. There's some liquidity that's been pent up there. It could have been a private investment of a private equity company that now is 5, 6, 7 years into their investment and needs some liquidity. It could be an aging board that has no real succession plan for management, and so the only path there is liquidity. So, an IPO, an equity offering can be a path for that liquidity for those shareholders. A sale is one that kind of gets that maximum value, that terminal value. So there's always a tug and pull between the bank remaining independent through maybe going public or an equity raise, and then ultimately selling for a higher valuation. And I wouldn't be surprised that most of those folks that are liquidating or need out and want liquidity want to get paid as high as possible. And that's typically going to be through a sale as opposed to an equity raise. So I think those things are accurate. And I think, you talked about being optimistic in 2026. We certainly are optimistic on where the capital markets are today. I'd say we're equally cognizant of the fact that capital markets can open and close off of one bad headline. And so we're extremely passionate about making sure our clients understand the opportunities they have today to really issue almost any types of capital the markets are open for if you're a good, strong, healthy bank, and taking advantage of that window while it's open, because it could close tomorrow as quickly as it reopens.
Yeah, that's a good point. So I know we're getting short on time, and I want to be respectful of your time, but maybe another question, but a different angle. Are there situations where a bank comes to you and says, "Hey, we want to raise capital, whether through debt or equity, and this is our story," and you go through everything, and you say, "You know what? I don't know that it makes sense for you to do this." Are those, I'm sure they're relatively few and far between, but is there any consistency as to why Performance Trust or any other investment bank would say, "You know what? I don't think you're either not ready, or it's just not appropriate for you, or this isn't the right story to tell." Is there any consistency with where you would say, "You know what? Let's hold off"?
On the equity front, absolutely. Typically when we're working with equity investors, they're institutional investors. And there's often times where banks just aren't ready, aren't mature enough, don't understand kind of what comes along with that. And so an equity investment from those type of investors, which can be great long-term investors, but you really need to up your game and you need to know what you're getting into. So there's often times where through conversations with us, we determine that equity capital is not the right answer. That conversation can certainly go to subordinated debt. I think we've been really actively talking about subordinated debt for banks, even if they don't have a transaction today, or even if they don't have a team they want to bring on today. The cost of capital and the spread tightening being what it is today, it still can be a really nice part of your capital stack and a really nice war chest to build. And so it's rare that subordinated debt doesn't fit a long-term strategy of a bank, because it's a 10-year instrument. Depending on who that bank is, there's usually a good opportunity over some period of time to capitalize on that sub debt and kind of park it while you're waiting to deploy it. But I'd say those conversations around capital not being the right option for you is more so around common equity and making sure the bank is ready for what that entails.
Great, thanks. Is there anything else before we kind of wrap up here? Anything else that you want the audience to know about either you or Performance Trust, or what you see on the horizon?
Yeah, I think the one other nugget I'd talk about as it relates to subordinated debt, there's been conversations, and you on the legal side might have more insight than me, but of the small bank holding company threshold lifting from $3 billion to something higher. Maybe that's 5, maybe that's 10. And so I think about all the banks that are currently $3 billion to, let's say, 10. They can't rely on subdebt the same way the banks below $3 billion can. So if that regulatory threshold gets lifted, I do think it opens up the landscape for a lot of those banks to take advantage of the way of subdebt in the same way smaller banks are. That could really kind of shift the dynamic of banks that have had to focus maybe more on preferred capital or common equity back into the land of subdebt. And so kind of maybe throw off kilter for a little bit the supply and demand. And so again, we're really passionate about what the opportunity looks like today for community banks to issue subdebt. If that goes up even higher from a $3 billion to higher, I think we'll see even more activity in the world of subdebt from those larger banks.
Yeah, I 100% agree. I mean, we've kind of already seen some of the regulators talk about community banking really being institutions that are under 30 billion in assets, which
Wow.
is a lot more than the $10 billion that we had been previously talking about. So, upping the small bank holding company policy statement from 3 billion to 5 or 10 doesn't seem like that far-fetched of an idea, at least at this point to me. So, I absolutely agree that would be really fascinating going forward.
Yeah,
Matt,
the really cool part about that, I'd say, is the really cool part. If that happens and those larger banks are able to utilize subordinated debt to kind of fund their business, fund their growth, it usually will mean those banks should be even more profitable, right? Because that cost of capital is significantly less than common equity or in most cases preferred. And so it would be great to see kind of increased profitability roll into some of those banks and help kind of the bank stock valuations that if you look over like a 3 or 5 year horizon haven't been great. We've seen a tick up of late, but that could add some more kind of earnings power to the banks and hopefully some more momentum into community banking in general.
yeah, no, I absolutely agree, 100%. Matt, this has been great. I really appreciate you being with us. I really appreciate the time. For our audience that needs your support, where can they find you professionally?
Yeah, LinkedIn is always an easy option. I'd say, my email, I'm pretty responsive as well, just mshields@performancetrust.com, or visit our website. There's a robust amount of connections, information, contact information on our website. So feel free to reach out with any questions. I would love to help in any way we can.
Yeah, awesome. I really appreciate it again, Matt. It's been fantastic. Hopefully you'll come back and we can kind of double check on your predictions for 2026 and going forward.
Absolutely. Thank you, Joe.
Of course. So that's all for today. If you have any questions from this or any of our podcasts, please let me know at jsylvia@dwaynemorris.com, or you can reach out to any of your favorite Dwayne Morris lawyers. Be sure to like and subscribe wherever you do get your podcasts. I appreciate everybody listening in. Stay tuned for new episodes coming regularly by Dwayne Morris and the Money and Banking Law Podcast. Thanks so much.